Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world's wildest financial stories, which for Putnam Diversified Income Trust means navigating a sea of investment jargon that frankly even makes my head spin sometimes. But hey, we're going to decode it. This report is packed with what happened over the last year with Putnam's Income Trust, and let me tell you, the numbers are interesting. And before we dive in, if you love getting these kinds of deep dives without the corporate fluff, hit that subscribe button, and hey, if you want to argue about these numbers or just hang out with fellow finance nerds, our Discord server is linked in the description below. Come join the party. So we're looking at the annual shareholder report for Putnam Diversified Income Trust, and it covers the period of October 2024 to September 2025. They break things down by different share classes, which is pretty standard. Let's get straight to the money. How much did it cost to invest in Putnam Diversified Income Trust, specifically Class A shares, over the last year based on a hypothetical $10,000 investment? The cost was around $101, that is about 0.98% of the investment. Now, they note that this reflects fee waivers and expense reimbursements. Without that, it would have cost more. Keep that actual cost versus potential cost in mind as we go. Now, for the performance, drumroll please, for the year ending the 30th of September 2025, Class of shares of the Putnam Diversified Income Trust returned a solid 6.28%. Not bad. How does that stack up? Well, they compare themselves to the ISBOFA US Treasury Bill Index, which for the same period returned 4.44%. So, Putnam's fund did better than this benchmark. Good for them. What made this happen? They say overweighting investments in top-notch and riskier corporate bonds helped. When bond prices go up, yields go down, and these spreads, which are like the extra yield you get for taking on more risk, tightened up. That's a good sign for bondholders. Their mortgage strategies also added to the returns. That includes both residential and commercial mortgage-backed securities. They mentioned that US homeowner finances remained strong, which is good news for those mortgage investments. Emerging markets also chipped in positively. When economies in developing countries do well and global interest rates go down, their bonds tend to do better. But it wasn't all sunshine. What hurt them? This term positive structural duration is a bit technical. Basically, they were set up to benefit if interest rates stayed low or fell. But when the yield curve steepened, meaning longer, term interest rates rose more than short-term ones. It ate into their returns. Think of it like having a long lever on a seesaw, and the other end went up much faster than you expected. Currency strategies also hurt them a little. They were betting on certain currencies doing well, but the opposite happened, especially with the US dollar weakening more than they anticipated. Now let's look at the big picture, the last 10 years for Class of shares. If you invested $10,000 10 years ago, and considering sales charges, your investment would be worth about $9,600 today. That is not a great return considering the impact of sales charges. But looking at the average annual returns, for the last year it was 6.28%, the last 5 years it was 2.70%, and over 10 years it was 2.93%. These are the returns without sales charges being factored in. When you add back those sales charges, the 10-year return drops to 2.51%. That is pretty modest for comparison. The Bloomberg US Aggregate Index had returns of 1.84% over 10 years, so Putnam's fund has performed better than this index over the long haul, but the initial sales charge really takes a bite. Let's look at some key numbers as of the 30th of September 2025. The total net assets under management are a massive $1,027,601,655. That is a lot of money. The portfolio turnover rate is a staggering 549%. This means they were buying and selling investments very, very frequently throughout the year. This can lead to higher trading costs, which eat into returns. It suggests a very active management style. Now, for some changes, effective the 1st of November 2024, something called Putnam Investments Limited, or PIL, merged into Franklin Templeton Investment Management Limited, or FTIML. Basically, the team that was advising part of the fund became part of a larger Franklin Templeton entity. This means FTIML is now a sub-advisor for the fund. And as of the 30th of September 2025, the portfolio managers are Albert Chan, Patrick Klein, Michael Sam, and Matthew Walkup. Keep those names in mind if you are invested. We saw the numbers for Class A shares, but they also have Class C shares. The costs for Class C were higher, $177 for a $10,000 investment, or 1.72%. This is expected due to the different fee structure. The performance for Class C shares was 5.68% for the year. This is lower than Class A, and again, they compare it to the Treasury Bill Index, which returned 4.44%. Then there is Class M. The cost here was $127 for a $10,000 investment, or 1.23%. The return for Class M shares was 6.04%. Class R shares had a cost of $112, or 1.09%, and a return of 6.19%. Class R6 shares were the cheapest to invest in, with a cost of just $64 for $10,000, or 0.62%, and they had the best annual return at 6.83%. Finally, Class Y shares had a cost of $75, around 0.73%, and returned 6.64%. It is clear that different share classes have different cost structures and performance outcomes. Generally, cheaper shares have better returns, but not always because of how they're distributed. Now let's peek at what they're actually investing in. This schedule of investments page is where the real meat of their holdings is. This is a huge list of companies and bonds. Corporate bonds make up a significant chunk of their investments, about 28.1%. Mortgage-backed securities are another big piece, around 20.6%. This includes government-backed ones like Fannie Mae and Ginnie Mae. They also hold commercial mortgage-backed securities at 8.1% and nearly 6% in senior floating rate interests. This category can be complex, essentially loans to companies that adjust their interest rates based on market conditions. Remember that over $1 billion in net assets, a huge chunk of it is in these long-term investments, totaling over $1 billion. Interestingly, their total investments, meaning what they paid for them, is actually higher than their current net assets. This is partly because of the liabilities they have, like those TBA sell commitments. They have these TBA sell commitments, which essentially means they've agreed to sell securities they don't own yet. This is a short position and represents a liability of over $62 million. On the flip side, they have about 21% in short-term investments, which are generally safer and more liquid things like commercial paper and US Treasury bills. A big part of that short-term pie is actually an investment in another fund, Putnam Short-Term Investment Fund, showing they're investing in their own company's products too. They're also using a lot of interest rate swap contracts. These are derivatives used to manage interest rate risk. The numbers here show the notional amount, the value, and the upfront payments. It's a pretty big part of their financial picture to manage risk. Looking at their derivative portfolio, there is a net unrealized appreciation of almost $2 million, which is a positive sign on paper for these contracts. However, when you look at their entire investments, there is a significant net unrealized depreciation of over $144 million. This means that even though some derivatives are up, the overall value of their investments has decreased on paper. Let's look at how they made money. Their net investment income for the year was over $56 million. That's from dividends and interest after expenses. But when it comes to selling investments, they had a net realized loss of over $5 million. Then there is the unrealized appreciation of over $11 million. This is the paper gain or loss on investments they still hold. When you put it all together, the fund had a net decrease in net assets of over $104 million for the year. This is a pretty big drop, and they paid out a massive $79 million in distributions to Class A shareholders alone. That is a lot of money going back to investors. Now, about the people running the show and their contracts, the board of trustees, who are essentially the overseers of the fund, reviewed the management fees and sub-advisory agreements. They say they carefully considered everything, including comparative fees, the quality of services, and the financial strength of Franklin Templeton. They mentioned that overall fund performance in 2024 was strong, even though the market was complicated. However, they also expressed serious concern about this specific fund's underperformance compared to its benchmark over the last 5 years. That is a big red flag. They specifically call out underperformance in commercial and residential mortgage-backed securities. The advisor, which is the company managing the money, says that this poor performance was mainly due to how the commercial and residential mortgage-backed sectors did. They've been trying to adjust the strategy to be more in line with other similar funds. But it's not all bad news. They did see your fund doing better than expected over the 1 and 3 year periods, closer to the middle or even above the middle compared to its peers. The trustees seem to believe in the investment process despite the recent struggles, and they mentioned the advisor has been making changes to its teams, including adding new portfolio managers. Looking at the bigger picture, they seem to be saying that while specific parts of the portfolio struggled, the overall process is sound enough that they decided to renew the contracts. They're hoping the changes they've made will lead to better long-term results. One crucial factor in renewing the contracts was the commitment to keep expenses low. They have expense limitations in place, and the advisor and their investor servicing agent are committed to these for a while. That's good for investors, as lower costs mean more of your money stays invested. When they looked at comparable funds, Their management fees were in the top tier, meaning they were among the cheapest. Total expenses, excluding certain fees, were in the second tier, meaning they are still competitive. This is a positive sign. But circling back to that underperformance, it is a clear weakness. The trustees are concerned, and rightly so. While they found some positives in the process and the cost structure, the long-term performance is lagging its competitors. As for my take, Putnam's Diversified Income Trust has a massive arm, over $1 billion, which is a testament to its popularity. They're trading a lot of their holdings with a turnover rate over 500%, which is aggressive and can be costly. Even if it's active management, while they did better than their benchmark in the short term, the 5-year numbers are concerning, and that substantial net unrealized depreciation across their investments hints at ongoing challenges. The fact that the trustees are renewing contracts despite this underperformance suggests they believe in the management's ability to turn things around, or perhaps the alternatives are seen as even riskier. The low fees for some share classes are a definite plus, but investors need to watch those long-term performance trends closely. So, what is the story here? It is a fund with serious scale and a complex strategy, trying to navigate tough market conditions and a historically underperforming area in mortgage-backed securities. They've got a good cost structure and a belief in their investment process, but the proof will be in the future performance. Alright, that is our breakdown of Putnam Diversified Income Trust's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.